everyone. Thank you for joining us for today's webcast. Gold, a safe haven without parallel, sponsored by Sprott Asset Management. Today's webcast will provide one CFP, one IWI, and one CFA CE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials, including today's presentation, have been made available for download from the document folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey that's also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you're interested in scheduling a one-on-one meeting with Sprott Asset Management, please click the blue confirm button in the meeting request box on your screen. Lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. With that, I'm pleased to introduce our first speaker today, Edward Coyne, Senior Managing Partner of Global Sales at Sprott Asset Management. I will now turn it over to Ed to get us started. Ed, the floor is yours.
Thank you, Sarah, and thank you all for joining us today for our webcast on gold, safe haven without parallel. We're excited to have both John Hathaway and Doug Groh, both from Sprott, join us today for this webcast. For those that aren't familiar with John Hathaway, John's a Senior Portfolio Manager at Sprott Asset Management USA, Inc., and Managing Partner at Sprott, Inc. John is a Portfolio Manager of the Sprott Hathaway Special Situation Strategy and Co-Portfolio Manager of the Sprott Gold Equity Fund. John earned his BA from Harvard College and his MBA from the University of Virginia and is a CFA charter holder. Doug Groh is a Senior Portfolio Manager at Sprott Asset Management and Sprott, Inc., and Doug is a co-portfolio manager of the Sprott Gold Equity Fund, as well as other investment vehicles in the Sprott Gold Equity Strategy. Doug earned his BS in Geology and Geophysics from the University of Wisconsin-Madison and an MA from the University of Texas at Austin, where he focused on mineral economics. For today's webcast, I've asked John to join us to talk predominantly about the macro view on gold, and then Doug will highlight the gold mining equities opportunity. At that point, we'll then open up the webcast to address many of the questions that have already come in today. And then we'll end that webcast, and then those that we don't get to, we'll actually respond to via email and or phone call. For those listeners on today's webcast that aren't familiar with Sprott, Sprott is a global leader in precious metals and energy transition investments. Sprott is a publicly traded company and lists both on the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. And with over $25 billion in assets under management, Sprott offers multiple ways to invest in both precious metals and energy transition investments. At Sprott, we offer three suites of primary opportunities. We offer a exchange-listed suite with over $19 billion in assets, whether you're looking to allocate to physical gold, silver, platinum, palladium, or other energy transition materials. We offer a full suite of trusts on the physical side as well as ETFs on the equity side. In addition, we have a full suite of managed equities where we give you a similar approach in a more active manner. And last but not least, we have a suite of private strategies where we do bespoke credit investments to mining and resource companies. So I'd now like to set the table for today's webcast by going back in time. If you look at what gold has done over the last couple of decades, many of our investors are surprised to learn that over the last 2+ decades, gold continues to do its job. In fact, it does its job quite nicely to the extent that it's actually been outperforming both the S&P, bonds, and cash. If you look at the compounded returns, gold's been up over 8% on an annualized basis. S&P's been up a little over 6.5%. Bonds have been flat. Our bonds have been up about 4%, and cash has been essentially flat. What I think is more fascinating, though, is that this decade, it continues. If you look at gold and silver on a short-term basis, meaning this last decade, from January of 2020 through 2022 through 2023, gold continues to do quite well in that environment as well. If you look at gold on a relative basis, it's actually held up quite nicely and it's actually outperformed, yet again, both bonds and equities. So I think it's interesting to really talk about today why gold is doing so well, both on an absolute basis and a relative basis, and why there's opportunities in gold equities today. And I think it all can get summed up quite quickly with this one chart on page 7 or quote. And this is something I've been using, frankly, for the last couple of years, and it holds more true today than ever before. And it just simply states that it's dangerous to accept that government spending, no matter how much or for what, is the only solution, and even more dangerous to believe that the shape of the recovery is only a function of the size of that stimulus package. Simply put, central banks do not manage risk, they disguise it. And we've certainly seen that this year, and we've certainly seen it in the last couple of years as things continue to unfold in the market. So with the table being set, I'd like to now turn it over to John Hathaway to talk about the macro view on gold. John?
Thanks, Ed. Let's move to this first slide. Remember that gold previously peaked out about 10 years ago, actually 2011, 2012, at around these prices. And so there's a lot of nervousness today that we may be setting in another peak. And I put this slide up here to show that investment sentiment is still quite low. The point that I want to make on this slide, and let's move to the next one as well, is that you rarely have a peak in any market when sentiment is poor. This next chart shows that the assets in GLD, the exchange traded fund, which is backed by physical gold, has fewer assets today than at the previous peak in 2011 and 12. So while we may be going through a period of backing and filling, and I kind of think that's where we are right now, just treading water possibly for a month, maybe 2 months over the summer. What I expect to have happen here is that gold will settle in around these levels. Maybe we'll trade down to 1900, and maybe we won't go to new highs, which would be 2075 or so. But backing and filling would actually be very constructive. And I kind of feel like these two charts that I've shown in the beginning of my talk are supportive of that view, because even though gold is knocking on the door of all-time highs, people aren't that excited about it. I know there's a lot of interest in it, but many investors have not moved into it. They're wondering whether they should, probably hesitant because they see gold at near the high end of its range for the last decade. Understandable that people would be hesitant to move in. And what I would like to see and what I expect to have happen is that we'll do some backing and filling, and investors will become more and more comfortable with gold trading around $2,000 an ounce. So let's move to the next slide. And this is similar to the slide that Ed showed earlier, and it shows basically that gold has outperformed everything in the universe over the last 20 years. It's a well-kept secret. But the point I want to make on this particular chart is that gold stocks have disconnected from the metal itself. And there are a lot of reasons for it. I don't think we have enough time to go into all of them. But the fact of the matter is that there has been a disconnect between mining stocks and the metal itself. I think the main takeaway from what I want to say today is that there's huge potential here for mean reversion. And that's if gold only sort of stays around the $2,000 an ounce level. If it goes higher, and in my next few slides, I'll explain my thinking on this, then I think the risk reward in gold mining stocks is extremely compelling. So let's go to the next slide. Maybe beating a dead horse, but bonds have been very disappointing. Investors think of them as a safe asset, as a risk diversifier. But as you can see here, and I guess it's not necessarily news to anybody listening, that bonds have been extremely disappointing. Was last year an aberration? Maybe. But I'd rather state the fact here that bonds are becoming increasingly risky for macroeconomic reasons. Let's go to the next slide. You know, the Consumer Price Index, CPI, has been revised something like 25 times in the last 30 years, 40 years, going back to 1980. In all but one of those instances, the revisions have been resulted in a lower rate of inflation, which leads me to sort of introduce the idea that trust in the CPI as a measure of inflation is fading. I mean, a lot of government statistics are massaged and tweaked for political purposes. I don't think there's any mystery to that. And the CPI is highly political. The slide here shows that gold and tips have separated. Tips basically pay investors if inflation rises. And you can see here that the correlation between gold and tips, which should be fairly tight if they're both insurance against inflation, has broken down. And I think the reason for that is of what I said at the beginning, that there's a lot of distrust that CPI is a true measure of inflation. And anecdotally, and I'm sure you all have stories of your own that would corroborate that view. Somebody said recently that buying inflation insurance from the U.S. government is like passengers on the Titanic buying shipwreck insurance from the captain. Again, this is only to make the point that bonds are not the safe asset and the risk diversifier that they were cracked up to be, or that people have thought. So caveat emptor on bonds. And it seems to me that while the Fed is on this crusade to crush inflation, I think the reality is that what they're going to do is crush the economy and probably end up reverting to the same policies that caused inflation in the first place, even if they succeed in bringing it down, which they're doing right now, but at huge cost and at huge risk to the economy. So my last slide kind of tries to tie all of this together. One, that investors really still don't believe that gold belongs around $2,000 an ounce. And I take this sort of lack of interest as a encouraging sign that there's a lot more upside based on macroeconomic factors for the gold price once it finds its footing around these levels. And, you know, expect volatility. I mean, gold is notoriously volatile in the short run, but as we've seen over the long run, it's proven to be a risk diversifier. And this is not the end of the story just because we're hanging around $2,000 an ounce. There are lots of reasons to think that gold can go substantially higher. Among them, and this is not an inclusive list, but credibility is crumbling in the U.S. dollar. We see that in many, many different ways. But the thing I would like to call your attention to, I know there's a lot of talk about the, and rightfully so, about the debt ceiling. And of course, we're in the stages of a high wire act, a dramatic finish before the X date of June 1st, when Secretary Yellen says that the Fed can no longer, that the Treasury can no longer meet its obligations. That exactly is not confidence inspiring. I think most people would agree or believe that there'll be a last minute save the day kind of kick the can down the road. But that's just a short term thing, and there's a lot of drama. It's very distracting. But more importantly, the fiscal picture for the US is, there's no better word for it, is ominous. Tax receipts are down substantially. I think through April, year to date, they're down 3%. Corporate tax receipts are down substantially more than that. And fiscal spending is up 13%. So you have a widening gap between income for the US government and outflow for the various things that the government pays for. The Treasury Borrowing Advisory Committee recently substantially increased its projections for deficits for 2023 to 2025, increased by 30 to 50%. That's 30 to 50% on a base of something like $1.5 trillion, which means, and this idea of the debt limit is a joke because they raise it every couple of years when they need to. But that means increasing supply of Treasury issuance, which are bonds. And again, another reason why bonds are not safe. In addition to that, you have spreading de-dollarization. And what do I mean by that? Increasingly, and I know establishment folks in the investment world and certainly in the political circles would disagree with this, but there's increasing flow of trade away from the US dollar. Oil is a good example. Increasingly, countries well, Pakistan would be one example, are paying for oil in Chinese currency. Saudi Arabia now accepts Chinese currency instead of dollars from countries that elect to use Chinese currency. The same is true with Russia. So de-dollarization is not necessarily something that's happening in the very short term, but it's an important trend, and increased use of other currencies, the Chinese currency being the major example, means that there's less of a trade surplus denominated in US dollars to buy Treasury bonds. And what that means is that you have increasing supply, as I've just explained, under the subpoint ominous fiscal picture, based on falling tax receipts and increasing deficits. And with de-dollarization, that means there's a smaller and smaller pool of trade surpluses globally to buy those Treasury bonds. So in a free market, that would lead to much higher interest rates. And so ultimately, policymakers will have very little choice other than to suppress interest rates through Federal Reserve policies, use of yield curve control, and that sort of thing, to keep interest rates down. It's basically a playbook for banana republic finance. And so lastly, trust in Fed policymaking is being shredded before our eyes. And I don't have to go too much into that because there's plenty of commentary that supports that. But what the Fed has done is they've raised interest rates at the fastest pace in 40 years. And the consequences are going to be a deeper and longer recession than the investment consensus is forecasting. And we're just beginning to see it. The data is becoming increasingly clear that we're headed into a serious recession. That's not reflected in earnings estimates. That's not reflected in valuations of securities. So what I'm suggesting is that equities, mainstream equities, have substantial downside risk. And you can see it in bank lending is starting to collapse. And if that will lead to slower economic activity. And my view is the Fed is about to do a face plant based on their policies that they're going to have no choice. And I'm expecting this to happen before the end of this year, but to revert to balance sheet expansion and interest rate reductions. And I think that we'll be back on the treadmill of higher inflation before they can declare victory. So just let me sum up and then give Doug a chance to talk. I would say that once this consolidation phase in the metal price is over, and investors become comfortable with gold being reliably priced around these levels, there's enormous potential for mining stocks to catch up. And again, I'm not even suggesting that a much higher gold price is necessary for gold mining stocks to have a big mean reversion trade. But if in fact the macro issues that I've talked about, de-dollarization, intractable fiscal issues, if they continue to plague policymakers with no solutions in sight, which I think should be fairly obvious by now, but people still have hope, then there's substantial upside for the gold price from here. And think about what that could mean for the gold stocks. Investors are skeptical that gold belongs at 2,000. They are unwilling, sell-side analysts are unwilling really to use models that have a $2,000 gold price beyond this year. But if that all changes, then a big mean reversion trade is in place because mining stocks and gold bullion are joined at the hip. Whatever the reasons are for the disconnect, there is a lot of reasonable rationale to suggest a substantial catch-up for gold mining stocks. And so hopefully I have set the table here for Doug, who's going to talk about how cheap mining stocks are, how much better managed they are. And so with that, I'm going to pass it along to Doug and be happy to answer questions at the end of the session.
Thank you, John. And John, right before we go to Doug, one of the things I think that might be worth reflecting, talking about recessions, what do you think in your estimation would that do to the gold price if we hit a recession?
Well, I think once a recession becomes inescapable and obvious to all, the Fed will, as I said, do a face plant and start expanding the balance sheet and dropping interest rates. That is very, very favorable for gold. So, getting from here to there could be a little rocky, but the end result would be policies that would be very beneficial for higher gold prices.
Thank you, John. And with that, let's turn it to Doug to talk about gold mining equities and the current opportunities we're seeing. Doug, thanks for joining us.
Thanks, Ed, and thanks, John. What I'd like to discuss today is the investment thesis and investment opportunities in the precious metal mining sector. And before I really get into it, I do want to point out and emphasize that as much as John mentioned that gold and gold equities are joined at the hip, they're really two different investment vehicles. Gold is, I think, appropriate for portfolios that are looking to offset some of the issues that John illustrated with regard to monetary and fiscal policy. But gold equities really are something a little bit different than that. They offer optionality and leverage to the gold price. So they are affected by the gold price, but they have value elements and value creation opportunities that are a little bit different from just the dynamics that drive the gold price. So as much as the gold price does drive some of the gold mining equities valuations, there are some inherent aspects of the gold industry that drive value and drive the performance of the sector. And I'm going to address the industry structure and the business model of the gold mining companies as a way to understand the opportunities that the gold mining equities currently present. I'll discuss the valuation of the sector along with the gold price that supports that investment thesis. And I'll do that by discussing the business model, the investment opportunities, and in particular, the valuations on the next several slides. On page 16, this slide speaks to the rarity value of gold, which itself is supportive of the gold price and gold mining equities. And on the right, you can see a depiction of the global gold production, and you can see that it is beginning to plateau. And we could spend some time discussing if we are witnessing peak gold production, but perhaps the better point to make is illustrated on the left-hand side of the slide. It shows gold discoveries have declined even as exploration budgets have increased. And production will certainly decline if new sources of gold are not found. And that idea supports the gold price, but also presents investment opportunities. Now, I'd like to now shift a little bit of the discussion to the precious metal mining industry structure and the company business models in the industry. And if we looked at the sector, we'd recognize as a way to categorize it, there's companies that are good at exploring for gold. There's companies that are good at developing ore deposits. And there's companies that are producers of gold, and they're good at that. And in some cases, the producers are doing all three. They're exploring, developing, and producing gold. But generally speaking, the explorers are good at doing just that, going out and identifying regions in the world or having access to countries where they can do exploration and create value through that discovery process. The developer's role is a little bit different. They're more focused on identifying the economic value, permitting a project, designing a mine, and then putting it into production, and perhaps becoming an operator and building a company. That skill set's a little bit different. It involves more engineering and financial expertise than, say, the explorers. And then you have the producers. And these are companies that are operating mines. They're generating cash flow. They're, as I mentioned earlier, perhaps exploring and developing new ore bodies. But their model is to stay in business for the long term. And as such, they have to add to their resources as they deplete them over time. So this kind of dynamic of the industry, I think, presents a lot of different opportunities, whether value creation is through exploration. There's an opportunity for investors to participate in that, or perhaps through de-risking a project. As a project is de-risked and closer to production, the market generally assigns a better value to that company. And then, of course, producers who are leveraged to the gold price and have opportunities to create value either through their capital structure or in the marketplace. If we can turn to the next slide then. I'll discuss this slide in terms of the revaluation potential that a higher gold price presents. but also in terms of the gold price leverage mining companies offer. This slide shows how gold mining equities have been undervalued compared to the past. And while gold prices peaked in 2011, gold equities have underperformed as capital has sought other markets. But now gold prices are once again on the rise. And for the various reasons we discussed earlier that John pointed out, investors have not yet embraced gold mining stocks. This could be for a number of reasons, whether it's the market structure or alternative investment opportunities or the perception of risk reward mining equities present. Part of it might be the past cycle where mining companies disappointed investors with the returns that they generated back in early 2010, 2012. And since then, investors have moved on to other opportunities and have not yet embraced the opportunity here that we witness in the undervaluation. It ignores the supporting dynamics of the gold price and the cash flows that these gold mining companies can generate. Closing that gap towards the historic trend or revaluing the sector is certainly one way to realize investment returns from the space. But I mentioned a couple of the different other value creating opportunities the sector has. And I'd like to address that now with regard to operating leverage. I think many of you are probably familiar with this, but just to illustrate, it costs about $1,350 per ounce to produce an ounce of gold. So $1,350 is about the cost of production. That provides about a $650 profit at current prices. So if gold prices go from $2,000 to $2,100 an ounce, that's a 5% move. But the profit increase is about 15%, going from a $650 profit to a $750 profit. Gold mining companies don't always directly participate in the gold price move, but they do generate a profit based on it. And the market will revalue those gold stocks based on that leverage at about 1 to 2 times to 3 times, and perhaps even more. So that a 1% move in the gold price can mean a 2 or 3 or even more percent move in gold equity valuations. And that's where the real opportunity is here that investors have really ignored and haven't really participated in. But in addition to the gold price leverage that operators can realize, the impact on the cash flows can be very significant. It also affects the asset value of a company. Gold deposits become more valuable because of the price when the price is rising, because they not only make the deposit more valuable, but they can make the deposit larger. Ores that were marginal in the past become more valuable, and rock that was not considered economic can become economic at higher gold prices. And that becomes a very important concept that is very much underappreciated by investors in general. And that's something that we look for at Sprott. We look for that element that the market is not valuing as a basis and thesis for our investment in the sector. So in addition to operating leverage, there is asset leverage. There is also potential for a benefit from financial leverage from a company's capital structure. And this is often expressed in a company's valuation relative to the operating leverage. And I'll address more about the financial leverage as we talk about valuations in a moment. Turning to page 18, though, or slide on page 18, another investment opportunity presents itself in the gold mining sector around the potential to grow and expand operations. This is kind of the structure of the industry where companies are maybe doing exploration efforts to find a deposit, but they can't build out that deposit. Another company will come around and perhaps acquire those assets in order to grow. Organic growth is certainly the best way to grow, but they can't always find a deposit. So we often see acquisitions as a way to enhance a company's operations, or grow its operations, or in a regard to replace its operations, replace its resources that have been depleted. I think it's also a way for management to maximize its capital position and reduce its operating costs. In simple terms, if you think of a large producer of 1 million ounces, they can be a more efficient company than a company that produces just 500,000 ounces of annual production. Since the larger producer can spread its costs across a greater volume of production, it has an incentive to have a growing profile. And that dynamic encourages the industry not only to explore for more gold, but also consider and pursue an acquisition strategy to acquire more gold resources. And that becomes a very important dynamic in terms of valuation and the opportunity in the sector. The sector is very active in terms of mergers and acquisition. It is a function not only of the industry structure, but also the capital markets that facilitate that. And also the geology of gold, for all that matter. Without getting into the weeds on gold geology, let me just say in simple terms, gold deposits are generally not large compared to other metal deposits. And as such, it takes more gold deposits to achieve economies of scale in order to realize favorable unit operating costs. An important aspect of gold's enduring value certainly is that it is not only hard to find, and that's important, but also rare and especially scarce when in demand. And that certainly supports the gold price, but it is not fully reflected in the mining company's valuation. And those companies own the gold resources and generate value from developing those resources for the capital markets. So the markets are really missing the opportunity that there are gold resources out there under development that have potential for growth, but the market is assigning no valuation whatsoever to that. With that perspective on gold's value and the industry's business model, let's talk about the valuations. On slide 19, we can see that relative to the S&P, the gold miners are undervalued. Enterprise value to EBITDA is 9.3 versus 12.5. Dividend yield is 2.3 against the market at 1.7. Net debt at 0.5 relative to EBITDA is compares to 1.3 for the market, and total debt 15% relative to 25% for the S&P. The sector is undervalued. I think for the risks that have been perceived in the past at lower gold prices. At these gold prices, the sector is generating very good cash flow. Operating costs, while they were under pressure last year during the inflationary period all markets experienced, cost pressures have eased significantly. And we're now seeing a better gold price, so margins are expanding. We dropped down to margins of about 25%. We're back up to margins of about 30 to 35%. Those margins should continue to expand. And yet the market, as much as these equities have done pretty well since October of 22, the equities are not fully reflecting the gold price and valuation, value creation that they offer. As we have shown in the earlier slides, the sector, is just getting overly discounted for its potential. And I think, the discount really is, an element of competition for the gold mining equities relative to the other opportunities in the gold space. Years ago, when investors wanted gold exposure, they could either buy gold coins or they could buy gold mining stocks. Now there's a whole plethora of different opportunities, whether it is coins or equities or ETFs or exchange traded notes or what have you, options or the futures markets. And investors are have more flexibility and opportunity to invest in different means to gain gold exposure. But the gold equity segment, the gold mining equity segment, is unique in that there's an opportunity to participate in not just the gold price, but also the value creation from a discovery, from the cash flows that can be generated, and the M&A, mergers and acquisition activity. We didn't discuss this too much, but all these companies are looking to grow, as I mentioned. And to do that, certainly exploration is key and discovery is paramount. But if you can't do that, then many of these companies are resorting to M&A activity, to acquisition activity. And I think the good example was demonstrated yesterday when Newmont announced that it was in agreement to acquire Newcrest from Australia, which adds substantially to Newmont's resource base. It should add to its cash flow over time. That type of consolidation is very much a part of the industry's business model, where smaller companies hope to be acquired and larger companies look for quality assets to acquire in order to build up their profile, as Newmont was trying to do yesterday, and to diversify from away from perhaps one jurisdiction or a limited amount of resources or one deposit. That becomes, I think, a very important element to the sector. And so, in conclusion, let me just say this: if there's anything you take away from my comments today, I hope it will be that you appreciate that gold scarcity and its rarity value presents a value in various investment opportunities that have not been fully appreciated by the market. And the structure of the industry and the business model of the mining companies offer a unique perspective for investors to participate in a real constructive gold price that we've been outlining. What we do at Sprott is to try to fully engage with the precious metal mining sector to identify those value opportunities, whether it's through that discovery or the growth potential, or perhaps in the M&A and capital markets where ultimately valuation and values are expressed. So we're very much engaged with these companies to try to identify where they're seeking value and capture that for our investors. So with that, Ed, perhaps there's some questions or comments we can address.
Thank you, Doug. And yes, before we go into the Q&A session, I just want to reiterate, what both of you actually talked about, both you and John talked about, which is really, I think, at the crux of it is that gold provides low correlation to other assets. And I think that should be one of the takeaways as well. As some of you that are looking to allocate to this space for the first time, as John said earlier, there's been a lot of interest, but there hasn't been a lot of allocation. We've seen people asking questions about it, but we haven't seen the capital necessarily flow into this space the way one would expect given its long-term performance patterns. But if you look at the general correlation to gold relative to other assets, simply put as U.S. equities or international equities, all the way through to fixed income and other commodities like oil, gold has traditionally had a low correlation over the last 2+ decades relative to other assets. And if you look at it on a shorter term basis, at just some of the bumps in the night we've seen over the last couple of decades, you see the positive spreads that gold has created relative to other assets like the S&P 500 and U.S. Treasuries as relates to what happened during the Ukraine-Russia war, things that have happened in COVID, Fed rate hikes, Eurozone crisis, and so forth. So this is an interesting chart to me for those that are now listening to what John has said on the physical side and what Doug has said on the equity side, that gold continues to do its job from a performance pattern standpoint, gold continues its job from an opportunity standpoint, and with all that, and with what gold's doing from a value standpoint, the gold equities are looking probably more attractive now than they ever have. So before we go to Q&A, I'd like to turn it back to Sarah, and then I'll start going through some of the questions we've been receiving, which is numerous. We've got 41 plus questions that have come in. And again, for those that we don't get to on this call, we'll certainly be responding to via email and or phone call. So I'll turn it back to you for a moment, Sarah.
Great, thanks, Ed. As a reminder, materials can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your questions in the box under the slides window. We'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. If you'd like to have a conversation or further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. With that, I will send it back over to you, Ed, for Q&A.
Great. Thank you, Sarah. And I guess this is always one of my favorite questions, which is sort of the crystal ball question, but it's one that everybody wants to sort of understand. And John, I think you talked about this a bit earlier, that we may be in a holding pattern in the short term here. But the question is this. What type of volatility do you feel gold will have for the rest of 2023?
I don't have a good enough crystal ball to be too precise about it. But, gold is, in the short run, appears to be volatile. Today it's down, $25 or so, which is 1%. That's a lot. But normally, I would say this year, it's been kind of in a stealth move higher, and the moves haven't been as big as we're seeing right now. The rest of the year, I think, I guess here's a short answer because I know we have a time limit. As these macro issues come to the forefront, and the dilemma that the Fed is in and that we've talked about and others have talked about become increasingly obvious, I actually think the volatility will pick up. And I think the moves will be, like we've seen today, more frequent than we've seen in the past. And, sometimes that's scary. But I think if you, to use a phrase a friend of mine uses, the forest for the trees, if you see through the forest and see what's really going on, the volatility will be resolved in a higher price at the end of the day. So hopefully that is a satisfactory answer.
Thank you, John. This next one I think is a good one for Doug to answer, and it really relates to cost. So we've talked about the quality of the balance sheet in the presentation, but we've seen the cost of running a mine go up over the last couple of years, like many businesses. Doug, the question is this: how concerned are you with rising costs as it relates to profitability within the miners?
Well, I think we were more concerned last year, and I think the market certainly was concerned last year, as illustrated by the performance of the gold equities. Last year, gold averaged the same price as the year before in 2021. The gold equities were down throughout the year, and I think that reflected your question about costs. We saw about a 10 to 15% increase in operating costs during 2022, 21-22. And we're still seeing a little bit of that impact, but we're beginning to level out on the costs. The cost seems more pronounced in terms of labor costs, but there were also input costs that did detract from profits. But that's reversing itself. Last year gold, I think, what it averaged, was it $18.25 or so an ounce? We're up $175 from that. That more than covers the cost pressures that many companies were seeing. So margins are expanding. And I think the important element there, Ed, is not just that we're seeing expansion now, but we will see better performance and quality of earnings in the next 2 or 3 quarters. So the comparisons will be much better. And markets will begin to register that and recognize that, hey, the cost pressures of last year, that's history. The opportunity is the current price and where that price is going. Investors have not embraced that whatsoever, as reflected by the valuations. So I think that's still in front of us. In some regards, the market seems to be looking through last year's glasses or lenses and is not seeing where the gold price is, where it's going, and what these companies have to offer. They don't have the leverage, the financial leverage that they had years ago. As illustrated in our valuation slide, they are way under leveraged financially relative to the S&P, where financial leverage is probably increasing there because of what's going on in the overall markets. They're in decent shape.
Doug, let's stick with this because there's another question that just came in. I think it's an interesting one that relates to profitability of these companies relative to cost. What is typically, or is there a typical number? The question is this: what is the cost of extraction for your typical mine? On a per ounce basis, I guess, is what they're asking.
Right. Yeah, there's a number of costs. There's, I'm going to get in the weeds here, and I'll try to get out of them quickly. But, there's the mining cost at each mine. There's the corporate cost to produce gold on a per ounce basis. There's the going concern type of cost if you want to keep operating into the future, which requires additional investment in exploration and development. At the mine cost is probably $850 to $900 an ounce. But if we layer on the corporate cost to operate a company, it's more like $13.50 an ounce or so. And if we lay on the taxes and financing costs and capital required to stay in business for the much longer term, and the capital costs are going up. And by that, I mean, $500 million to produce 125,000 ounce annual producing mine. That's the kind of capital that's required. Incorporating those type of costs, the cost of production is closer to $1,500 an ounce to even higher. So every company has a different cost profile depending upon their geology and depending upon their corporate makeup. Generally speaking, large open pit mines can be quite efficient. Underground mines, high-grade underground mines are attractive because they're high-grade, but they can be expensive. But the high-grade offsets some of that cost. So every company's a little bit different in terms of their profile.
Thank you, Doug. John, this one should be, I think, addressed by you, and it's actually a two-part question. Part one is, gold has been under-owned for a long time. What environment do you think will change that?
I think the environment we're in will change that. It is under-owned. It's incredibly under-owned. It's been a pariah in the investment world. And we have plenty of research on this, look at the weighting of gold in portfolios in the Western world. And I don't have a number off the top of my head, but it's less than 1%. And I would be astonished if the events that I see ahead of us, steep recession, reversal of Fed policy, ultimately more inflation, if that didn't lead to wider demand for gold ownership, I'd be very, very surprised.
Thanks, John. And I guess the part two of the question that we should address, which I think you've already kind of addressed before, but it's worth mentioning again, is, let's see here. You say gold has had this time. We've seen this once before with gold hitting over $2,000 an ounce. Is this market peak 2.0, or do you think this is here to stay?
That's exactly my point. That we've been here before, and the next 10 years were kind of nuclear winter for gold and gold stocks, and the markets were terrific. I think we are, to use the Bridgewater term, in a new paradigm. Things have changed dramatically, especially on the macro side. The last time gold was in this $2,000 neighborhood. I should mention that if gold were priced on an inflation-adjusted basis at its previous peak in I think 1980, it should be 26 or 2,700, just to equal that $800 an ounce in 1980. So I know there's a temptation to get nosebleed at this level. That question doesn't surprise me, because I think it's on the minds of many people. But I think the answer to it is in look at the predicament that we're in today compared to the last time. And then answer the question for yourself. Do you think a bigger allocation to gold makes sense?
Thank you. And this, go ahead, Doug. Sorry.
Yeah, if I can just offer a perspective, on that. I think it's interesting if you look at 2011, when we went through a debt ceiling discussion. The gold price rose from June of that year to August, the end of August, by about 19%. Gold, and the market was down about 7%. So we're, as John points out, we're kind of in the era where it has every reason to go up. And I think here's an important element to recognize. Many people wonder or question the value of gold, or the longevity of gold's use as an alternative investment or as a means to stabilize a portfolio. And I think you have to look very much at the long term. If you think about the market in long-term cycles, commodity markets can go about 7 to 11 years downturn before they go up again. And we've witnessed that in the gold sector. And there's some technical work that's being done out there that's suggesting that we're now at the bottom of a new range on gold. And while it may sound preposterous to say, well, gold's going to 3,000, John just illustrated that on a CPI adjusted basis, $3,000 is not that crazy compared to where gold was in 1980 at $800 on an adjusted basis. So we're stepping up into a realm, and I think everybody's recognizing in the world that things are different. The pandemic changed things. The energy markets are different. Political responsibility is different. So I think people have to recognize that, the past isn't necessarily where we're going back to. I think a different price range on the gold price should not be surprising, where our new floor might be about $1,800 or $1,900 an ounce, and our upside is closer to $2,700 or $3,000 an ounce. It's kind of hard to grasp that, I think, sometimes, but I think it's a very realistic prospect.
Thank you, Doug. And I think we have time for one more, and I think we'll end with an allocation question. And there's sort of a question and a statement in here, so I'm sort of breaking it out for y'all. But it says, at current market and looking forward, what would be the recommended percent of mining versus metal weight for a high net worth client? And then it says in quotes, not looking for the typical 5 to 10%, but want the real recommendation now. So I think given that we're bullish, given the comments we said, what should someone really be thinking about when they're looking to allocate to both gold and gold equities? John, maybe let's start with you. What kind of percent would you recommend? And then Doug, let's wrap it up with you talking about how much of that should be miners versus the physical market. So John, what would you say to a typical person asking about an allocation to gold today?
The 5%, 5 to 10% is kind of apocryphal. I mean, that was always what the Swiss bankers did back in the 1970s, and they actually did it. Today, if there was a 5%, even a 5% allocation to physical metal, I think that would be enough to take the gold price up to the numbers that Doug was talking about. So yeah, let's get you all to 5% to be for starters, and see how that feels. Because I know nobody's there.
Ed, I'll speak to my own experience. I have about 7% of my portfolio personal portfolio invested in gold, in the gold theme, and about 2% of that is physical, and the other 5% is equities. And the rationale is the equities offer leverage to the gold price, and the gold physical offers sustaining value over the long term. So that's my approach.
Thank you, Doug, and thank you, John, for that. And thank you, everyone, for listening. We've got actually a total of 61 questions, so we obviously don't have the time to address all those. But as I mentioned, for those that are on the East Coast, you'll be hearing from Sergio Lugin on many of the questions you've had. For those in the Central region, you'll be hearing from Julia Hathaway, and from those on the West Coast, you'll be hearing from Matt Harrison. So, be on the lookout for that. We'll certainly address all the questions, both by email and/or phone calls in the coming days. And thanks again for everybody for participating on today's webcast. We appreciate your interest, and for those that are currently investors, your support. So thank you.
Thank you all.
All right. Great. Thank you to all of our speakers today for such an informative discussion. As a reminder, materials have been made available for download, can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. If you would like to have a conversation and further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. Thanks so much for joining us, and have a great rest of your day.